And for those of you guys who are new, Queen's Court is where I come in with an idea or a trade thought or just, just a conversation in general about trading. And I'll present it over to Matt or whichever coach is here with me on Tuesdays. And we have a discussion and they kind of give me some insight on what would you do, or what would they do versus what I'm thinking, and to see whether we're in line. So in talking about the Tackle 25, by the way, again, great webinar last night on that list. And of course, I was waiting to see what was going to be in there. And so the question I have for you, and I'm pretty sure that this is a question that a lot of people are going to have in the community, is now we have the list. We've gone through all the different analysis. We've got all the fundamentals. We've narrowed down to what we want to have in our portfolio. You alluded to this earlier. We do have earnings coming up. So if you've got a stock, and I'll give you 3 that I'm looking at. Okay. If you've got a stock that's got earnings coming up, do you wait to acquire it until earnings is passed, or can you go ahead and do it now if the pattern is there? So here are my 3.
Okay. FCX. Give me your 3. FCX, a little Freeport action.
Apple and Microsoft.
So you got a little Freeport action, then you got the big dogs. Okay.
So I'm looking at the pattern on FCX going, I love it. I want to get in, but it's got earnings on the 26th. I'm looking at Apple. I'm loving the pattern there. I want to get in, but we've got earnings. So I'm just trying, it's like, do I?
First and foremost, we got to understand we're not talking about a trade here.
Yes.
Okay. We're talking about more of an investment position, something along those lines. So just let me be clear on your question, Em. You're looking at parking money in an instrument over a given time period, and you're looking to cash flow on that instrument with covered calls over that time period, correct?
Yes, I am I'm looking at my long-term portfolio. I need to add some stuff to it. I've narrowed it down to FCX, Apple, and Microsoft.
So the question for me then, because this isn't a trade, right? It's an investment. You can hold through earnings if you need. But again, if you're going to write covered calls, you need to collar it so that you're protecting, so you're locking the risk graph down both sides. But again, the simple reality is in any investment, you're going to hold through a lot of earnings. Okay. And I don't have any problem if that's your first earnings in 2 weeks from now. Like you're going to hold through it. Like if you're going to hold FCX for the year, you're going to hold through 4 earnings. Exactly. You're not going to get in and out of it. You're going to learn how to cash flow on it. You're going to learn how to protect the earnings. You're going to learn how to collar the trade if you need to, but you're not going to get in and out of a long-term holding. You're just not going to do that, nor would anybody recommend that, right? So the question is, should we wait to see the earnings response to that blue dot in 2 weeks?
Yeah.
Or do we just take the breakout here?
Yeah, I mean, look at it. It's so pretty.
To me, earnings is a complete crapshoot. Like take Albertsons here today. Albertsons had an awesome earnings report. They beat EPS numbers, they beat revenue numbers, they beat that, and they also show an increase in guidance. And we see nothing but a sell down throughout the entire day. Like, and Coach Mark said this earlier today, yesterday. He's like, well, yeah, I could see some runs up and then some pre-planning selling on the earnings numbers, or some pre-planning buying on the earnings numbers. There's a lot of things that can happen on earnings that we just are not prepared for and never can be prepared for because we don't know the mindset of the institutions of how they're going to approach earnings. You can see the best numbers in the history of mankind and the stock go down simply because an institution decided to use earnings as a way to liquidate some of their holdings, right? So it just can be a crapshoot is what it could be. It's 50-50 probability. If you think you have an edge on earnings, you don't. You just don't. Don't try to overthink earnings because you can't. Earnings is, put it like this, the market collectively is smarter than you are because the market is a collection of the intelligence of every participant.
Yes.
So you can't get an edge on the market when it comes to earnings. Now, the second question I therefore have then is, how does earnings historically behave on XYZ company? Is there some danger zone there, right? Do we have a history of FCX being very volatile around earnings? Because if we have a history of FCX being very volatile around earnings, we may want to wait, right? We may want to wait until after the volatility subsides so we can get a little better picture. And whether or not that's a gap down, gap up, we'll analyze that in the real time. So when you're looking at FCX over the last 4 earnings reports, here's one right here, little gap down analysis, right? Little gap down analysis there. I wouldn't say nothing too crazy though, right?
Yep.
Little gap, recovered 1 day later, wouldn't say too crazy. Next one right here. That's a doji.
That's a nothing.
That's a nothing burger. That's an inside candle. Like inside candle on earnings. Okay. That's another day that ends in Y. Here's earnings here, right? Little bit of nothing burger.
Yep.
Little bit of little hammerish. Little MC Hammer. Let's rock and roll. Little nothing burger. Here's there. Little gap down recover. Little gap down recover there. My point is, there's nothing in the last 4 earnings that is too concerning, right? That you would be like, oh, we got to lock that down and we got to, run for the hills type scenario. I'd have no problem with somebody picking up FCX and saying, you know what, I'm going to pick it up. I like the stock. I like the theme. I like the zone it's in. I'm going to pick it up and I'm going to write covered calls. And maybe you write a covered call and you lock it down with the caller trade just to cover the risk of earnings, because you certainly can do that, guys. I mean, if you're so worried about earnings, there are ways you can eliminate the risk to earnings. You write the covered call and you buy a put option. And by doing so, for example, if I come to FCX here and let me just show the risk graph on it, because the risk graph will tell new traders far more than whatever my words on a caller trade. Because if I start talking to new traders about callers, they're like, yeah, I have a caller. It's right here. It's fantastic. Well, what we do in the caller trade, if you go to the risk graph here, I went to buy the stock. So if I go in to just buy the stock right now, right? So Emily wants to buy the stock. Well, she's got an open-ended risk graph, right? And if earnings are a problem, and if you're concerned about earnings, you're concerned both on the top side and the bottom side, okay? Because you don't understand the gapping situation. So what you want to do is you try to lock down both sides of the ledger just to reduce the volatility of the earnings. And so what typically people do is you can just buy a put option if you're concerned. Right? You can just come to the market and say, I'm going to buy a put option, and let's just go buy, say, a 27 Delta. I'm going to go buy $100 put option. Well, I'm selling a $100 put option. I was getting very aggressive there. I'm going to buy a $100 put option, and I'm going to lock down the left-hand side of this risk graph. Okay, so that's what I'm going to do. If I'm that concerned, and I just want to open it up and I'll write covered calls after earnings. Okay.
Yep.
I could just come to the market, buy a put option. I'm risking $100 per 100 shares on the put option to protect against this stock going down from, say, what's the current price right now? 42. So we're protecting. Basically, we're saying it can go all the way to 41. We don't care. Okay, we're giving up that $100. And so I can do that. And you look at this. If we get to see a nasty, nasty gap down, oh, we're locked down. We're good because we have the right to sell it at $39. And so you can go out there and you can buy a put option to lock that left-hand side of the risk graph down. You see, if it gaps up, we still have an open-ended risk graph if it gaps up and we're rocking and rolling. Well, what a lot of traders do when they're just doing covered calls, because that's a strategy you do when you're just trying to protect against the risk to the downside in an investment. You just go out, you buy a short-term put option to protect against the event. Once the event is passed, you don't have to own the put option. You sell the insurance back to the market, right? But if you're trying to maximize your cash flow in your covered call here, and you want to carry your covered call with that, well, there you still got the same risk graph. Let me come back to the Analyze tab. You still got your lockdown over here, but what you do in the covered call environment is you go sell that 37 Delta contract at 45. You bring yourself in $145 of cash flow. You then use basically, and think about it like this from a mindset perspective, it's going to cost you $1.17 to buy the put option. Well, what are we doing? We're selling a call option so that we can go buy our put option. We're using Emily. I'm selling you a call option. I'm taking your money and I'm going to go buy a put option from somebody else. And the reason I do it is I just want to lock down both sides of the risk graph. And as you can see here now, what do we have? Left-hand side's locked down under 39. Right-hand side's locked down under, above 45. We've basically, by collaring the trade, if you wanted to carry the covered call through, you collared the trade to eliminate both sides of the gapping risk. And so when you're looking at FCX here and you're saying, oh, should I wait on earnings? Well, earnings is not that big of a deal on FCX. That's number one. It will gap a little bit, but then most of the time it recovers. Number two, if you do have some concern and you're not ready to start writing covered calls, you can just go buy that put option. And if you're the veteran, you can go do it and just go do the collar trade right now and not even worry about it. Right. And so you do have options here. But to answer specifically, and I just wanted to take a moment to kind of explain kind of the philosophy there. But when you're looking at it from just do I need to worry about earnings risk, right? Do I need to worry? I don't think you have to worry on FCX. Now, again, this goes without saying, but I'm going to say it a million times. Any stock in any environment can do anything. FCX can gap down, I was going to say 30 points. That would be shocking, but it can do it. You have to accept that. I don't care if it's Apple or Microsoft, you have to accept the belief that any stock can do anything at any moment. Okay. And so you got to take that into account. But the history does show me that FCX does not have that much volatility around its earnings. That's what the history shows me. When you're looking at Apple, another tackle 25 darling. When you're looking at Apple, I don't even need to look at Apple. I can tell you this on Apple. Apple gaps 4% every time it's without fail, up, down 4%. If you can't handle 4%, you shouldn't be dealing with Apple because it does it all the time. The market maker move is always going to be 4 to 5%. Apple's always in that range of 4 to 5%. Very rarely do we see anything too crazy from a volatility perspective. So the answer, if you're looking at an investment, you know you have 4 to 5% movement coming into the short term on earnings. I think you can withstand that from an Apple perspective. And once again, you have the same options because it's a tackle 25 stock and you know you have the liquidity there. You have the same options to be able to go out there and buy that put option to protect the downside if you have a little bit more bias to the upside on the earnings, or you can collar the trade as well. Microsoft here, I have a very similar belief. And again, this is the beauty of tackle 25, guys. You don't see 20% gappers a lot. This is the beauty of looking at a stock like a list like the tackle 25 when you know you have the underlying fundamentals and the value and the volatility skews you're looking for and the liquidity you need to do everything you need to do on a system like the tackle 25. Yeah, I have great confidence in any stock you put on. You would give me from the tackle 25. Same conversation though, but there's a little bit different conversation I have on Microsoft. We don't get a lot of dips like this on Microsoft. They happen a couple times a year, and every time those times happen, anytime Microsoft gets 10% down, guys, it's got to be a watch list candidate. It just has to be. It has to be. It's one of the best companies in the world. It's got growth to it. It's got value to it. It's got great cash flow rates to it. Anytime this stock gets about 10% down off the highs, it's got to be looked at. And that's where we're about at that 10% downward movement in price, tight against earnings. Once again, with Apple and Microsoft, I don't have the concern with FCX. I do have a little bit of concern with Apple and Microsoft not running on any fuel in the market right now, not running on any theme in the market right now. Those things can change really, really, really fast, though. I do like Microsoft at a low price. Maybe it's at 300, but I do think it's got to be looked at here because, again, I just don't feel we get a lot of dips on Microsoft in that 10%. And when they do, they all confirm. Look at it here. From the tip to the trough, 306 to 280. You're talking about 8-9% there. Gets under the 50, boom, skyrockets. Tip to trough, 263 down to about 340. 263, yeah, about 10% down. What happens? Double bottom, take off, fly. Tip to trough here on that retrace. See, Microsoft doesn't do bullish retracements. It does either correction or skyrocket. That's what it does. 246 down to 225, about a 23-point movement against a 240 stock, about a 9% movement. And so It does it a few times a year, but it doesn't do it a lot. You get that right around 10%. I do think Microsoft has to be looked at in those environments. And again, if you're going to hold anything through earnings, it's going to be with the put option this quarter, in my opinion.